Hi everybody and welcome to this month's Market Essentials report for May. The big news this month, of course, is that the most recent data from Domain Group shows that the March quarter actually fell into negative territory for national property prices around the country, and they recorded a negative 1.2%. And that is predominantly because of the APRA regulations coming in and the banks really clamping down on both investor activity and apartment developments. However, the Reserve Bank has made note that they probably won't be continuing such stringent measures in the future, especially around interest-only loans, due to the potential of mortgage stress coming into the marketplace. Now, looking at Sydney is predominantly the biggest drag on property prices today, with house prices falling into negative territory at negative 3.8%. We're also seeing very sluggish auction clearance rates at around only 58% these days. Now, yields for rentals have fallen to their lowest in a long time, with 2.8% rental yield for houses and only 3.8% rental yield for units, some of the worst in the country. However, we've got to keep in mind that New South Wales is a juggernaut when it comes to the economy, and it is having one of the strongest unemployment rates right now at only 4.8%. So that's really great news for New South Wales on an ongoing basis. Now, when it comes to Melbourne, we've seen that Melbourne is actually on the top of the food chain now, according to one of CBRE's most recent surveys, showing that foreign investors in the Asia Pacific region actually favour Melbourne, especially over Sydney, Sydney has fallen from first place to actually 8th place. Now, in saying that, Melbourne is following a similar trajectory to Sydney, and that it is slowing down quite considerably and only showed a 0.1% increase in the March quarter data, which is the slowest in the last 5 years. So it does indicate that Melbourne is probably following a similar trajectory to Sydney in the coming months. Now, we all know that there is an oversupply of units in the inner city Brisbane market that is affecting the market overall. That's no surprise. BIS Oxford Economics has actually come out and said that up to 10,000 units may actually be delayed in construction, holding off until at least 2025 until they feel that the market is picking up. Now, in saying that, the Australian Development Review has also come out and said that Brisbane is now one of the most affordable cities to invest in, with units at around 389,000 and houses at around 549,000. We're also seeing around $30 billion being invested into the Gold Coast market for both public and private infrastructure, which we see as a great bonus moving forward, and hopefully something that's going to really propel that southeast Queensland area. Market woes continue for the Perth market, with CoreLogic's most recent data showing that Perth's CBD market has actually proven to be one of the most unprofitable across the nation, with prices falling over 25% in the last 10 years and nearly 30% from their peak in 2006. It also shows that apartment sales for this year have fallen to 26,000, which is actually lower than the apartment sale numbers that were recorded back in the 1990 recession. So not good for Perth market. Even though we're seeing some signs of it bottoming out, it's probably not a market to be driving into just yet. Strong confidence continues for the Canberra market, with Property Council survey showing one of the strongest results in the index to date. We're also buoyed by the fact that Canberra has taken the mantle for the lowest unemployment rate across the country at only 4.1%. However, what we're seeing in the development side of things is that now that 3/4 of development is now being apportioned to units. So this is something that we will keep an eye on in terms of supply in the pipeline and potential oversupply and impact on property prices. Slower results in the Adelaide market has caused the ANZ research team to revise their growth expectations for their June quarter from 1.9% to only 0.4% in the coming months. Now that's probably been supported by the very high unemployment rate that they are carrying, with one of the highest across the nation at 6.3%. Now that being said, the median price point has marginally increased by only 1% to make it one of the most expensive that Adelaide's seen on record at $470,000. However, the slower unemployment or the slower economic growth in this area will probably be holding back significant price growth moving forward. Darwin's headaches continue as well, with one of the worst quarters that we've seen at a negative 7.5% price decrease. The Northern Territory government is looking to a new project for fracking, love it or hate it, that may increase or improve the economy and hopefully will pass on to property prices. We're seeing vacancy rates continue to climb, which is hampering the rental market. And unfortunately, we've seen very high utility bills coming out of Darwin, which is making it one of the most expensive cities to live in when it comes to utilities, behind Sydney and Melbourne. Not a great boon for property prices moving forward. So that's it for me in this month's Market Essentials report for May. We'll be bringing you the same next month, and I hope you really enjoy the updates. My name's Josh Masters, signing off on behalf of Buyside.